Current trading for Circle Internet Group Inc., ticker symbol CRCL on the New York Stock Exchange, is sitting right at $83.80, showing a downward intraday move of approximately 2.88%. If you are watching the charts this morning, you are seeing a stock that is struggling to find a bottom, currently hovering near $83.80 and looking soft. The market expectation for a company that issues a stablecoin, USDC, is that the equity itself might offer a degree of stability, or at least a predictable, boring growth curve tied to interest rates and adoption. The reality, however, has been anything but stable. Circle has become a proxy for high beta crypto exposure rather than the safe, regulated utility play many initial investors thought they were buying. The expectation was a steady compounding machine. The reality is a volatile roller coaster that has seen shares skyrocket to nearly $300, only to crash back down to earth, currently trading nearly 70% off those dizzying highs. This massive disconnect between the stable nature of their product and the chaotic nature of their stock price is exactly what we need to break down today, because the market is clearly mispricing the risk, or perhaps it is finally pricing it correctly after months of euphoria. Let's look at what is happening on the tape right now. At $83.80, Circle is seeing significant selling pressure. We are seeing volume metrics that suggest institutional distribution is still active. This isn't just retail traders panic selling. This looks like a structured unwind of positions that were likely accumulated during the hype cycle immediately following the June IPO. When a stock drops nearly 3% in a single session without a specific headline-driven catalyst, it often points to a liquidity vacuum. Buyers are simply not stepping up at these levels. The bid-ask spread has widened slightly, indicating nervousness among market makers. You have to remember, this stock touched a 52-week high of $298 just a few months ago. To see it trading in the low 80s today is a psychological blow to anyone who bought into the future of money narrative without checking the valuation multiples. The price action today is testing a critical support zone. If $83 fails to hold, the technical damage could open the door to a retest of the post-IPO lows around $64. The momentum indicators are flashing oversold, but in a falling knife scenario like this, oversold conditions can persist far longer than your solvency can endure. Investors are currently grappling with a severe hangover from the post-IPO party. When Circle debuted, it was hailed as the adult in the room, the regulated, transparent alternative to offshore stablecoins like Tether. The market treated it like a high-growth tech software stock, awarding multiples that made absolutely no sense for a business that essentially operates like a narrow bank. You have a company that takes in deposits, buys short-term treasuries, and pockets the yield. It is a fantastic business model when interest rates are high, but it is not a software-as-a-service model with exponential scaling leverage. The market priced CRLC as if it were the next NVIDIA stock, expecting explosive margin expansion that simply isn't mechanically possible in the spread business model. Now, reality is settling in. The stock is correcting to a valuation that reflects a financial services company, not a hypergrowth tech unicorn. This alignment process is painful, and that is exactly what you are seeing on the chart today. The selling we are witnessing at $83.80 is the air coming out of a speculative bubble, leaving behind the core value of the business, which is real, but significantly lower than where the hype train took it. There is also a macro angle pressing down on the stock today. The bond market is signaling potential shifts in the yield curve. Since Circle's primary revenue driver is the interest income on the billions of dollars of reserves backing USDC, any fluctuation in short-term rates directly impacts their bottom line. If the Federal Reserve signals a more dovish stance, or if the market anticipates rate cuts to stimulate the economy, Circle's profit engine sputters. The algorithm trading bots know this. They are programmed to sell CRLC the moment the 10-year or 2-year Treasury yields tick down. It is an automated correlation that creates headwinds for the stock, regardless of how well the management executes. Today's drop of nearly 3% is likely exacerbated by these macro fears. Traders are looking at the yield environment and asking themselves if the peak earnings for Circle are already behind us. If rates have peaked, then Circle's net interest margin has likely peaked as well. And in a forward-looking market, you do not pay a premium for shrinking margins. This expectation of peak yield is a heavy anchor dragging on the stock price, preventing any sustained rallies. It is interesting to contrast this with the sentiment around other retail-heavy favorites. When you look at Tesla stock or even Apple stock, you see companies that control their own destiny through product innovation. Circle, however, is tethered to the whims of monetary policy. They can't just launch a new iPhone to fix a drop in interest rates. They can try to increase the circulation of USDC to offset lower rates with higher volume, but that is a slow grind, not a quick fix. This structural limitation is something the retail crowd often overlooks. They see crypto and think moon, but they should be thinking fixed income arbitrage. This misunderstanding creates a constant supply of disappointed bag holders who sell when the stock doesn't behave like a meme coin. Speaking of holdings, I want to hear from you. Comment below how many shares of Circle Internet Group you currently hold and what your average entry price is. Are you underwater from the highs, or did you manage to get in near the IPO price? The variance in investor experience with this stock is likely massive given the volatility. Let's shift gears to the competitive landscape, because that is another source of tension weighing on the price. Circle is not the only game in town. While they pride themselves on being the compliant, white-shoe stablecoin issuer, the market dominance of Tether has not waned. In fact, offshore stablecoins continue to eat up market share because they are often easier to access for the developing world and high-frequency traders who don't care as much about U.S. regulatory compliance. Furthermore, we are seeing aggressive moves from traditional finance players. If huge institutions decide to launch their own bank-backed stablecoins or tokenized deposits, Circle's moat could evaporate. The market knows this. The discount you are seeing in the stock price today reflects the risk that Circle might eventually be squeezed between unregulated offshore giants and massive onshore banking competitors. It is a precarious position. The company has to run fast just to stay in the same place. They need to aggressively lobby for favorable stablecoin legislation in Washington, which is expensive and uncertain. The recent political shifts and the Trump administration's stance on crypto regulation are tailwinds, theoretically. But regulatory clarity works both ways. It legitimizes the industry, which invites competition from the big banks that have been sitting on the sidelines. If JP Morgan or similar entities fully enter the stablecoin arena with their own token, Circle's value proposition is challenged. We also need to discuss the Robinhood effect on this stock. CRLC is a favorite on platforms like Robinhood and SoFi Invest because it's an accessible way for equity investors to bet on the crypto ecosystem without opening a separate crypto wallet. This creates a specific kind of volatility. The shareholder base is likely skewed toward shorter-term traders and younger investors who are quick to hit the sell button when momentum turns. This lack of a stickier institutional shareholder base means the sell-offs are deeper and more violent. We saw this with other fintechs in the past. When the momentum breaks, there is no pension fund waiting to buy the dip at a 3% discount. The stock just freefalls until it hits a deep value zone. We are seemingly in that freefall phase now, looking for a floor. The activity on Fidelity brokerage accounts and Interactive Brokers platforms shows a mix of capitulation and tentative accumulation, but the net flow is still negative. It feels like the market is trying to flush out the weak hands who bought the narrative at $200 and are now capitulating at $80. Now let's peel back the layers on the company's actual business operations, stripping away the stock price noise. Circle Internet Financial is, at its core, a payment infrastructure company. They issue USDC, which is a digital dollar. For every unit of USDC in circulation, they hold $1 or a dollar equivalent asset in reserve. They make money on the interest from those reserves and increasingly on transaction services and treasury management solutions for businesses. It is a clean, understandable business. There is no complex algorithmic alchemy here. It is simple banking physics applied to the blockchain. This simplicity is their greatest strength and their greatest weakness. It is a strength because it is transparent and relatively safe compared to the Wild West of crypto. It is a weakness because it is a commodity business. A digital dollar is a digital dollar. It's hard to differentiate your dollar from someone else's dollar except through trust and network effects. Circle has done a fantastic job building that network effect. USDC is integrated into thousands of apps, wallets, and protocols. It is the lifeblood of DeFi. But the stock market is asking, is that enough? Is being the plumbing